Every day you are told that the economy is a mystery, that the future is uncertain. But what if the future wasn't uncertain? What if the timeline for the next global economic collapse was already written? In 1972, a team of MIT researchers made a prediction that was so terrifying, so accurate, that mainstream economics tried to bury it forever. They calculated the precise moment when our system, our entire global way of life, would face catastrophic collapse, and we're still right on schedule. Like and subscribe to the Lazy Economist for more cinematic explanations of how money really works. The study was called The Limits to Growth. It wasn't about politics or central banks. It was about something far more fundamental: physics. The researchers at MIT didn't use economic models. They used a system dynamics model, seeing the world as one giant machine with interlocking feedback loops. They fed the computer data on population growth, industrial output, food per capita, pollution, and the non-renewable resources we consume. Their conclusion, their main hypothesis, was chilling: that continuous, exponential economic growth on a finite planet is a mathematical impossibility. And the model pointed to a catastrophic overshoot and collapse, not in 2100, but in the lifetime of most people watching this. The core problem is best described by a simple metaphor: the ship and the lighthouse. Imagine the global economy as a massive, speeding cargo ship. Our financial and political institutions, the crew, are only looking at the ship's speed and cargo weight. They see growth, they see progress. But the MIT model was looking at the lighthouse, the carrying capacity of the planet, the point where the ship's needs exceed what the port can sustain. As the ship of industrial output gets bigger, it consumes resources faster and produces pollution faster. This creates a hidden drag on the system. The economy is designed to look at a single variable, GDP, but the system is only designed to look at physics. This isn't just theory. We've seen the principles of overshoot and collapse play out, not globally, but in microcosms. Think about the 2020 to 2023 surge in inflation. Most of the conversation focused on money printing, on quantitative easing. That was step A. Step B was the supply chain collapse. The ships couldn't get to the ports. The parts weren't available. This was framed as a pandemic issue. But step C is the truth behind the system. The real reason those supply chains broke was the decades of running the system too hot. We hit the limits of efficiency, the point where the cost of finding the next resource or managing the next piece of waste exceeds the profit from the industrial output. Here is what you never hear in mainstream finance. The engine of the collapse is not a single event. It is a concept called the decline of net energy. For every unit of energy you put into the system, the investment, you get units of usable energy out. This is energy return on energy invested, or EROEI. 50 years ago, EROEI for oil was perhaps 30 to 1. Now, because the easy-to-find resources are gone, we are fracking, deep-sea drilling, and using enormous amounts of energy just to extract the next barrel. The system behind the system is the simple fact that when EROEI drops too low, the energy available for everything else, healthcare, roads, and leisure, dries up. It's not a financial collapse, it's an energy collapse that forces a financial one. So what does a model from 1972 mean for your investments in 2025? It creates a new framework for survival. Rule 1. Stop chasing paper returns. Financial assets are just claims on real-world energy. If the energy collapses, the paper returns become meaningless. Rule 2. Prioritize resilience over efficiency. The old mindset was maximum output for minimum cost. The new mindset is robustness in the face of collapse. This means assets that require less energy to maintain, local land, self-sufficiency skills, and perhaps most importantly, decentralized hard currencies like gold or Bitcoin. The market rewards intelligence, but the system rewards robustness. The terrifying prediction of 2040 is not a prophecy of doom. It is a diagnosis of a system that refuses to read the meter. The MIT model was not forecasting the end of the world. It was forecasting the end of a specific paradigm, the belief in unlimited growth. The collapse is not the financial crisis. The collapse is the recalibration. The moment the financial reality is brutally forced to meet the physical reality. The money in your bank account is not the promise of tomorrow. It is merely a claim on today's energy, and that claim is rapidly losing its backing. The market doesn't reward intelligence. It rewards the wisdom to understand the physical world you operate in. The 2040 deadline is a warning, not a certainty. The system is still running its course. But the choice is not to fight the mechanism. The choice is to build a life, a portfolio, and a mindset that is resilient to the inevitable correction. To move from a pursuit of volume to a pursuit of longevity. Subscribe to The Lazy Economist for weekly cinematic breakdowns of money, markets, and the machinery behind them.